We need equations in order to analyze the economic impact of transactions, as they provide objective information about the economic events of an enterprise. And then they must be recorded in accounting books. To get valid results, we will need to know both the simple and the extended equations, and what their components consist of.
The accounting books. There are 3 accounting books to record all transactions in companies. First, the journal book, that is an aggregate book which presents raw accounting data. The ledger book, that includes the same information that the journal book but in different way. And the last, the inventories and financial statement book, is another compulsory accounting book with the initial balance sheet, quarterly trial balance, and the financial statement.
An account refers to the record of all the changes in a particular asset, liability, or stockholders' equity. It is a T-shaped tool and it is used to keep track of transactions. Each transaction generates twofold impact in the firm's equity, an origin and a destination. It is called double entry bookkeeping. How does it work? The T account has 2 sides: the debits entries on the left and the credits entries on the right. If the debits entries are bigger than the credit entries, we have debit balance. If it is the opposite, we have credit balance. And if the 2 sums are equal, we have zero balance.
Regarding the accounts, revenues and expenses, both work in an unilateral way. Revenues are always credited and expenses debited. However, assets and equity and liabilities work bilaterally. The initial value of assets is debited. If these assets decrease, we put it on the credit side, and if they increase, in the debit side. So debit must be equal or bigger than credit, having a debit or zero balance. In the case of equity and liabilities, it's all the way around. The result must be credit or zero balance.
When recording a transaction, we have to imagine the answers to 5 questions. 1. What accounting elements are involved in this transaction? 2. Where do those elements belong to, meaning to assets, liabilities, or equity? 3. What is the effect of this transaction? Does it increases or decreases? 4. Where do those elements start with, by debit or credit? And 5. What is their value? Accounting is kept on an accrual basis, which means revenues and expenses are recorded in periods in which they are realized and not in periods in which actual cash flows occur. The most common accounting adjustments are accruals for realized interest expenses, adjustments for realized parts of prepayments, and adjustments for depreciation.
The last part of the lesson refers to trial balance, that in a very simple way is just the small table we made to verify once more that the accounting equation assets equal equity minus liabilities is correct. In order to do this, we just make, as I said, a small table and we start rewriting all the debit and credit accounts with their quantities and just check if they are the same.